Hey there, John Hunter coming to you again this week with another topic. This one is APR versus interest rate and what is the difference? This is a question I have gotten my entire career. It's super common when we get through the disclosures, when we get to that truth in lending disclosure that says, hey, your rate is 5%, but your APR is 5.38. And people will look at me and say, what's the difference? And which one matters, right? So it's important to understand the difference because those two terms are used interchangeably and they serve similar functions, but they're so different. So let's talk about what they are. So interest rate. Interest rate or note rate is the actual rate that you are going to be paying. That is what everything is calculated. Your payment is calculated based on using your note rate. And the note rate is a percentage. So you always see, 5% or 3% or 7%, whatever it is. It's always a percentage, right? So that's the one that really matters the most because everything's calculated on that, right? Now, the annual percentage rate is nothing but a disclosure, right? It is the cost of the loan represented as a rate, okay? So it's important to understand how they calculate this. So for those of us, had a little bit of accounting, it's the way it works is, let's just use round numbers for a second. So let's say 5% rate, $100,000 loan and $1,000 a month payment, right? That's not accurate, but I'm rounding everything off just to make it easier to understand. So 5%, $100,000 loan, $1,000 payment. That's note rate, 5%. So how do we calculate APR? Let's say the closing costs were $5,000, okay? The annual percentage rate is calculated by taking that $5,000, subtract it from the loan amount. Well, so instead of 100,000, now you have 95, and then we do what's called solve for rate, right? So we figure out what rate would we have to be at to have that $1,000 payment, but a $95,000 loan, okay? So that's always going to be higher. So because it's a lower loan amount, right? Subtract the cost. What rate would you have to be at to have the same payment? So that's why you will get a note rate of 5%, but subtracting the cost out, it might be 5.3, right, to get the same payment. So the greater the cost, the bigger the difference between the note rate and APR. That's the whole point of this disclosure, is so at a glance, you can judge whether it's an expensive loan or not. The difference between note rate and APR is the whole point of it, right? That's how you judge cost, right? Now, I wish it were that simple because it really isn't, right? Especially with mortgages, right? Because they use the APR disclosure on everything from credit cards, car loans, whatnot. It's a little bit better gauge on some of those other products because there aren't a lot of costs associated with them. So any of those costs can really skew it. But with mortgages, there's a lot of costs, right? Everybody's got their hand in the pot with mortgages. So, we have everything from interim interest to appraisal, title. There's, a lot of fees that go into the APR disclosure. So when comparing apples to apples, it's important to understand what these things are. So, back to the interest rates really quick though. The interest rate is determined based on loan amount, loan type, credit score, all of that. Plus of course, the cost of funds from the lender, right? Fannie Mae or Freddie Mac issue a base price and then they make adjustments for those other things. And that's how they come up with the note rate. And then APR is cost. So, not all the fees are included though in the APR calculation. Some are and some aren't, right? And some of the fees can kind of skew the APR. The one that I run into the most is interim interest. So interim interest is when you close in a month, say like this month, in the month of November. If you close on the first day of the month, your payment in November, your first payment's due January 1st. But because we close on November 1st, we have to collect days of interest from the 1st to the end of the month. So we have 30 days of interest. That 30 days gets factored into your APR. Now, what happens if your close date, exact same cost across the board, but your close date is November 30th, right? Now you have 1 day of interest calculated in your APR, so your APR is lower. Now, did the actual or true cost of that loan really change? Because you're only paying for the days of interest that you own the home. Not really, but the APR is different, right? I'll see some lenders will skew their APR by quoting end of month closings when, say, the contract says you're closing on the 10th, because it makes your APR lower and it's easy to explain later what the change is. So that is something that you have to watch out for. So when you're comparing quotes and you're comparing costs, pay attention to the details because it matters, right? Close date has to match. Everything else should be apples to apples. And a big one too is ARMs. Adjustable rates when calculating APR don't factor in future adjustments. So if you're going to compare, make sure you're comparing arm to arm, right? Similar arms, right? Because a 1-year arm compared to a 5-year arm with similar start rates could have dramatically different costs over a 5 or a 10-year period because the adjustments happen quicker on the shorter term arm. So comparing apples to apples is really important. Pay attention to that stuff. It matters. So let's see here. Federal Truth in Lending requires that the lenders all follow the same rules for the most part. But like I said, that interim interest is a big one that can change. Make sure everything matches. We're supposed to follow all the same rules, but like I said, there's some wiggle room within that. And just remember that your payment is not based on the APR. The annual percentage rate takes into affect things like mortgage insurance, right? Mortgage insurance on an FHA loan is over the life of the loan versus a conventional, which you might be able to drop in 2 years. So there are things like that factor into it, but the note rate is what your payment is based on. All of the disclosures, except for one, the Truth in Lending disclosure, will have the note rate on it. The APR only shows up on that one disclosure, the Truth in Lending, and that's it, because it's nothing more than a disclosure rate. It's not, none of the numbers are based on it. So that's important to remember. APR can be a wonderful tool for judging cost at a glance. That's really what it was designed for. So hopefully that answers the question, the difference between note rate and APR. It's not rocket science, but people use those terms interchangeably so much it can be confusing. Hey, I'm John Hunter. I'm your mortgage guy. You have any questions? You want a rate quote? You want some numbers? Call me, reach out. If you have any questions on any of this, if you want to comment, please like, subscribe. Every week I come with a weekly update on rates. This one's a good one this week. I think the trend is exactly what we were all hoping for. I've got some good news coming tomorrow. So this is Thursday. You'll probably be seeing this on Monday, but watch every week, subscribe, and get the news as it comes out. So have a wonderful week, and I will talk to you soon. Bye-bye.